Welcome to the deep dive, everyone. Today, we're tackling something really key if you want to understand complex businesses, their financial statements.
That's right. We're looking specifically at IFRS 10 on consolidated financial statements and also IAS 27 on separate ones.
Exactly. And our mission really is to unpack how these standards help reveal a company's true financial identity. We've got a neat visual overview to guide us.
And these standards are just so powerful. Without them, you're often just seeing bits and pieces, not the whole story.
Hmm.
They're vital for understanding the actual size and health of a whole group of companies. Stops a giant looking small, basically.
Absolutely. So where do we start, I guess, with the basic idea of these groups of companies?
Yes, that's the foundation. And tied right into that is the principle of substance over form.
Substance over form. That sounds important.
It really is. It means financial reporting has to focus on the economic reality, what's actually going on, not just what the legal contracts say on the surface.
So it's about the truth behind the paperwork.
Precisely. Think of, say, a really long lease. Legally, it might look like you're just renting, but economically, it could be much closer to actually buying the asset. Substance over form makes sure the accounts reflect that reality.
Okay, got it. So that stops companies playing games with legal structures. But how do accountants figure out when to actually combine the financials of these separate companies? What's the trigger?
The trigger, the absolute key element, is control.
Control.
Right.
But what does that mean here? Is it just owning most of the shares?
Well, it's often not that simple. IFRS 10 looks beyond just, say, owning 51%. Control can come from dominant voting rights or the power to appoint the board, or even specific contracts that give one company power over another's key financial and operating policies.
So it's about who's really calling the shots, regardless of the exact ownership percentage.
Exactly. And you often see this arise in business combinations, mergers, acquisitions, where one company takes charge.
Makes sense. And I see our overview mentions things like exclusions and exemptions, too. Quick nuances.
Yeah, important details. Like you might exclude a subsidiary if you're only holding it temporarily to sell it, or exempt a parent if it's already included in a bigger group's consolidated statements. Avoids double work, basically.
Okay, so control is the trigger. Once that's established, IFRS 10 kicks in with the consolidation process, how you actually combine everything.
That's it. IFRS 10 lays out the mechanics. And a really interesting practical detail it covers is results of intergroup trading.
Intragroup trading, meaning sales between companies within the same group.
Yes. Imagine a manufacturing part of the group sells to the retail part. From the outside world's perspective, no real sale has happened yet.
Right. The group hasn't sold anything externally.
Exactly. So IFRS 10 says you must eliminate those internal profits and transactions from the consolidated accounts. Otherwise, the group's overall performance looks inflated.
That's crucial for an accurate picture. What other practical things does IFRS 10 cover? I see accounting year ends.
Oh, definitely. You can't easily combine financials if one company's year ends in December and another's in June. IFRS 10 requires adjustments for that.
And consistent accounting policies.
Absolutely vital. Everyone in the group needs to measure things the same way. Inventory, revenue, whatever it is, apples to apples.
Makes sense. And the date of acquisition or disposal must be key too.
Fundamental. You only include a subsidiary's results from the date you actually gained control or up to the date you lost it.
Okay, so IFRS 10 gives us that big combined picture. But why do we still need IAS 27 for separate financial statements? Doesn't IFRS 10 cover it all?
Good question. Well, separate statements are still needed. Think about it. For legal reasons in certain countries, or maybe for lenders to just one specific company in the group.
Or maybe shareholders who only own a part of a subsidiary.
Exactly. Non-controlling interests. They need to see how their specific investment is doing on its own. IAS 27 tells companies how to prepare those individual statements, often accounting for investments differently than in the consolidated view. It provides a different lens.
Right. Different layers of information for different needs. So let's bring it back to the listener. What does all this IFRS 10, IAS 27 control substance mean for you when you look at company reports?
It means you're equipped to see the whole picture. You can understand the true scale, the interconnectedness, the overall financial health of an entire business group, not just one isolated entity.
It lets you see beyond the single company name on the building, essentially.
Precisely. It's like seeing the whole iceberg, not just the tip.
So we've covered quite a journey. IFRS 10 and IAS 27, the importance of substance over form, and how control is really the central concept.
We have. And maybe the final thought for you, the listener, is just this. Understanding these consolidation principles gives you a much, much richer view of a company's real performance and reach. It's knowledge that lets you look past the surface level.
A powerful tool for anyone trying to understand modern business. Thanks for walking us through that.
My pleasure.